Happy New Year and welcome to the first video of InvestBetter.io. In this video, we take a look at Apple stock, the most valuable company in the world and a favorite of Warren Buffett. According to the last filings, the current value of his Apple position is $176 billion with 916 million shares, or just over 50% of his entire portfolio. So let's take a look at Apple using our software to analyze and value the stock in the beginning of 2024. Looking at the overview, we see the current stock price is $185.64. Yesterday, on the first trading day of 2024, the stock dropped by almost 3.6% after a downgrade from Barclays. In the last year, the price rose by almost 50%, far outpacing the S&P 500 index. Zooming out to the last 5 years, we can see a dip at the end of 2022, where, like many tech stocks, the prices dropped because of rising interest rates and the fear of a recession. But then OpenAI introduced ChatGPT, and tech stocks became the most popular stocks for 2023. And while Apple does not have a real AI product, they did also see a major rise in the price. Like I said in the intro of this video, Apple is the most valuable company in the world with a current market cap of $2,887 billion, or just shy of $3 trillion. The current PE ratio is just below 30, which is high but can be explained by the revenue growth recent years and profit margin of 25.3% in the last year. The stock does pay a small dividend, 95 cents in the last 4 quarters, or just 0.5% dividend yield at the current stock price. Not really interesting for dividend investors, but a nice bonus and probably a way to get on the radar of investors who only want to invest in stocks that do pay a dividend. Looking at the financials for the last 12 months, or last 4 reported quarters, we see a revenue of $383 billion. The table shows 0% compounded annual growth rate, but this is because the last 4 quarters are also the full-year financials. When we look further, we see almost 1.6% yearly revenue growth for the last 3 years and just over 8% revenue growth per year for the last 5 years. This clearly indicates that Apple profited from the corona pandemic and the years that followed. The net income and free cash flow show a similar growth, where we see higher percentages for the last 5 years than the last 3 years. We can see it in the charts as well, where in all 3 charts we see an improvement from 2020 to 2021, and then the bars seems to stay relatively flat. We can say that Apple sold a lot of products in 2020 and 2021, when people worked at home and replaced their Apple products, or people switched to Apple products because they had extra money to spend. But they were able to keep this revenue in the years that followed. It no longer showed a large growth but did not decline much either. And scrolling down the table with financials, we can see they had a couple of years with big revenue growth, like 2015 with almost 28%, 2018 with almost 16%, and 2021 with more than 33% revenue growth. We can also see that following these years, the next year we always saw a small decline in revenue of between 2 and 8%. During the last 10 years, we see the gross margin climb from around 38% to now almost 45%. The net margin was around 21 or 22% for years. But after 2020, it rose to around 25%, showing that Apple has the ability to increase its prices and become even more profitable without losing to much sales or customers. This results in a massive growth of the earnings per share in the last 10 years from $1.61 per share in 2014 to $6.13 last year. This is not only because of increasing net income, but also because we see the shares outstanding decrease between 3 and 7% per year for the last 10 years, so profit is divided amongst a smaller amount of shares. All this data from this overview page will be available for free when we launch our website in the following weeks. So subscribe to our channel to see more videos like this, and we keep you posted when we launch our software. Now let's take a look at the scorecard for Apple. We can see the stock scores 78 out of 100 points, giving us an indication. But when we look at the scorecard, we can see how the stock scored at different categories. These categories give us a better overview of the stock and its performance and can help us identify subjects we want to do more research on. First, we take a look at valuation, where we see the stock scores no points. This is because 3 different ratios are higher than we want to see. This does not have to be a bad thing, because if the stock scores very well on other categories like debt, growth, and profitability, it makes sense that investors are willing to pay a premium for a stock. We already took a look at the growth on the overview page, but the 5-year growth is important in our score because we take a look at long-term growth. Also, the management scores very well because of the low debt ratio and high return on invested capital. Here we can see they bought back an average of 3.2% of shares per year for the last 5 years. And that is not the only way they reward shareholders. Like we said, they also pay a small dividend. The current dividend yield is only 0.5%, but this is growing on average with 5% per year for the last 5 years and currently only is 15% of their free cash flow, showing they have the ability to keep growing it in the future. We also have a score for 2 financial ratios, showing us how well the company performs, and a category for analysts, but we will look at that in a moment. First, we take a look at different charts. This page shows us all the important data, but in a visual way, making it easier to quickly get a great impression of the stock. We see revenue grow for the last 10 years, and the charts for net income and free cash flow show a similar pattern. We see a big improvement in earnings per share because of higher profits and a decline in shares outstanding. The return on invested capital was very high and has been high for the last 3 years, showing a big improvement compared to pre-2020, but we should take into account that it might decline in the future. Finally, we see the margins like we did before in the table, and here we clearly see an improvement after 2020 for both gross and net margins. If you want to dive deep into the financials, we have a page with the financial statements. Here you find all the data you need for the income statement, balance sheet, and cash flow statement. You can switch between annual and quarterly data and go back 40 years in the case of Apple stock. If we look at the dividend, we can see more details. This chart shows us the earnings per share, free cash flow per share, and the dividend paid, and is a great way to see if the company is able to pay the dividend. In the case of Apple, there is enough money to make these dividend payments. Scrolling down, you can see a table with all the dividend data, like the adjusted dividend and when it was paid. Next, we take a look at analysts because they can help us in our research and prediction for the future. On average, analysts have a price target of $190, or almost 3% upside the current price. The lowest price target of $110 means a 43% decline, while the highest price target of $240 means a 24% upside. You should never blindly follow these price targets because we don't know what assumptions they use in their valuation model. That is why we think their prediction for the revenue and earnings per share are more interesting. For the next years, they predict an average revenue growth of 4.5, 6.6, and 11.3%, and an earnings per share growth of 4.2, 11.2, and 12.5%. For 2024, this is based on 32 analysts, on 2025 on 22, and for 2026 we only have data for 3 analysts. We see strong growth after 2024 and also higher percentages for earnings per share growth, indicating Apple will be able to become more efficient and profitable after 2024, according to analysts. At the bottom, we see a chart with recommendations. For this month, there are 38 analysts with a recommendation, 21 analysts with a buy rating, 11 with a strong buy, 6 with a hold, and there were no analysts with a sell rating. Now it is time for a valuation of Apple stock. We did a quick analysis, and with the data we saw, we will try to predict the future. Using these assumptions, we calculate if the current price is interesting to buy the stock, or if we can better wait for the price to drop. At this moment, we have 3 valuation tools, but this will be expanded in the upcoming months. First, we use the multiples valuation, where we try to predict the future earnings per share and using a PE multiple, come up with a stock price. In this case, we make a valuation for the next 5 years because we have data available from analysts for this period and because it is not too far in the future, so we can predict with more confidence. We use a bear, base, and bull case to have 3 scenarios for the future, where we assume the base case is the most probable. We have revenue growth of 5, 7, and 9% per year based on historical growth and predictions from analysts. We saw the profit margin increase the last 10 years, and the average has grown from 22.8 to 25.3%. We think this can be improved in the future, so we assume 24, 25, and 26% profit margin. For shares outstanding, we assume -2, -3, and -4% per year. Next, we have the PE ratio, a very important part in this valuation because this is what we use for our multiplier. We can see the current PE is over 31, the average for the last year is just below 28, for the last 5 years below 25, and for the last 10 years below 20. That is why we use 20, 24, and 28. Next, we have the required return, or our margin of safety. When investing in a single stock, you probably have more risk than when you invest in a well-diversified ETF where you can expect about 8% per year. That is why we require 10, 11, and 12% per year in these scenarios. After we press the button to make the calculation, we see 3 prices appear. These are the stock prices we want to pay for each scenario and are based on our assumptions and required return. The first 2 prices are in red, indicating that the price we want to pay is lower than the current stock price. In the last scenario, we see a green price of $192.10. Because the price we want to pay is higher than the current price, this might be a good moment to buy the stock if you believe in these assumptions. If you want more detail, you can press the button Show Calculations. A table will appear with the data that is calculated and used for each scenario. Let's take a look at the base case. In this scenario, we expect the revenue to grow to $537 billion in the next 5 years. Using our 25% profit margin, we expect a net income of $134 billion. The outstanding shares decrease to 13.3 billion, so when we divide the profit by the shares, we expect earnings per share of $10.06 in 5 years. Multiplied by our P/E ratio of 24, the stock price would be $241.50. But we require an annual return of 11%. That's why we want to pay $143 right now. Should we buy the stock at the current price, we can expect a return of 5.4% per year. And while this is a positive return, it is not the required return of 11% per year in this scenario. We can also value the stock using the discounted cash flow. Here we take a look at the cash flow for the company and make assumptions for the future. In the table, you see the free cash flow for the last 10 years. It grew from almost $50 billion in 2014 to almost $100 billion in 2023. The next table shows us the compounded annual growth rates for the last 1, 3, 5, and 10 years. We try to be more conservative here. We go for the 7% average from the last 10 years. This model does not only look at the cash flow, but also the cash position, total debt, and the shares outstanding. Now all we have to do is input our assumptions. In this case, we do it for the next 10 years, and we assume a growth of 7% per year. The perpetual growth is used for the calculation after these 10 years, and while the normal percentage is 2.5, for Apple we use 3%. We use a discount rate of 8%, and when we press calculate, we see a red box appear. This indicates our calculated price of $174.48 is below the current price, indicating the current price is not the right price to pay. Finally, we take a look at the Lynch valuation. The famous investor Peter Lynch always made charts to get an impression for the stock price. He put the price and earnings per share in the same chart and looked for a connection. You expect that both lines go in the same direction, because stock price always follows earnings or goes in the direction the earnings per share are expected to go. In this chart for the last 10 years, we see that price shot above the blue earnings per share line in 2020 for the first time, and at the end of 2021 it was far higher. But then the stock became volatile and dipped into the blue several times. At this time, it is far above the current earnings per share and also for the expected earnings per share for the next few years. This is another indication that the stock price might be too high, and you can better wait for a moment for the stock to dip into the blue. Zooming out to the last 20 years, we still see a similar image. We can clearly see earnings per share grow after 2008 because of the introduction of the iPhone, and the stock price followed. But also on this time frame, the price seems too high at this moment. But that is how we look at this stock at this moment, using our own assumptions. Let us know what you think of Apple stock and its price, or what stock you would like to see in the next video, and drop a comment below. Also, subscribe to our channel to never miss a video, and we keep you posted on the launch of our software. Thanks for watching, and we hope to see you again in the next video.